Pizza Lotto.
Hey everyone, my name is Matan Azanov and welcome back to my channel. Today I have a very special guest, a rarity amongst Canadian entrepreneurs, Mark Nashman, who built his business to 420 employees and over $50 million in revenue before being acquired by IBM. Mark then took his incredible experience as an operator into venture capital, and I think he has a lot of insights to share on how to build startups, how to invest in startups from his experience being both an investor and an operator. And we're lucky to have him today. Mark, great to see you again.
Great to be here. Thank you.
And let's start off. Tell us about your background, experience, education, whatever you'd like to share.
Long time ago, it seems now. I was a computer science undergrad well before computer science was a hot thing. Then an MBA, and then try to figure out what I wanted to do. So I went into consulting initially. I always thought I'd have a business get started with some kind of startup, although I had really no idea what specifically it would do. I just thought it would be a tech-related business. The strategy was just kind of stumble upon a good technology. And then when I see something, start a business around that. And that's kind of how it played out. So it's been a great ride and a lot of fun.
That's great. So were you always an entrepreneur, or after graduating from an MBA program, you went into a corporation and then started a business?
Yeah. So after MBA, I got a job in a mid-sized consulting firm in Toronto. And you realize how much you don't know. Like there's lots you don't know. So that was good for a few years. Then I went freelance consulting after a bunch of little changes. Which was very good for me because you start feeling you're distant from the company you're working for and you're more open to new opportunities. And then one of my gigs exposed me to some new technology that was very hot at the time and became the basis of what we started our company, which is Clarity Systems at that time.
Great. Yeah. So tell us a little bit about Clarity Systems.
Yeah, so I was working at Grand & Toy, which is the office supplies company. It used to be very well known in Canada, much less so.
I remember them.
Yeah, they were huge at the time. And then Staples came in and just crushed them. And they just weren't able to deal with the big box model. But in preparation for that, they put in a bunch of new systems. And I was one of the IT consultants there. And one of the things was a new BI tool, a new analytical tool. And I was the project manager for this project to build a new reporting tool. And they thought we'd build it from scratch at the time. It was more of an IT thing. And I thought, this is crazy. There's got to be some good tools out there. And we found some great tools from Cognos at the time and a back-end database called Essbase and this new thing called slicing and dicing data with OLAP databases, online analytical processing databases. Anyway, it was a really great project. We had this fancy front end where you can double click on a piece of the pie and drill into it, which was unheard of in the mid-90s. And myself and the guy I was working with on the project thought, this is great tech. Everyone would love this. And with the help of the sales rep for the core database that we were using, we started branching out to not just do our own freelance consulting on our own, but started Clarity Systems initially as a consulting firm. And the great thing about a consulting firm is you don't need capital. You just need some expertise. So we just built up our expertise. Our big expense was to print business cards. And then we were consultants. We didn't really need an office, didn't need any other overhead. So we really just printed business cards. And the sales rep who through which we licensed the database for Grand & Toy said, look, you guys did a great job here. I've got other projects. I need on-site consultants. I'll give you their leads. So he would send us leads and then we'd find more work. And we quickly realized if we just do more work ourselves, we're just cannibalizing. We could build from a Grand & Toy, we could build a new customer. So the only way to make this thing work is to hire more consultants and get them working for us. And so we built a consulting firm, and over 3-4 years or so, we had 50, 60 employees out doing contracts for us. And it was a really nice business, but it was a consulting firm. So not highly valuable from an IP perspective. But able to get it going and build cash flow without any need to raise capital, go through the kind of the VC model, or to borrow money from the bank. It was really self-funded. And then we found we're doing the same projects over and over again. And so we built up initially what's called a toolkit, and then we had this starter kit we would license to people, and the starter kit and licensing kit became a software platform. So we started the company in 96, and by 2000, 2001, we were starting to license our toolkit, and that became more and more of a software platform. And then you start leading with the software platform as your entry point into new projects, and start getting some licensed revenue, which is really nice. Then you have to build a dev team to kind of support the product. And so you start building departments of a proper software firm. And so we transitioned from 2000 to 2003 from a consulting firm to a software firm with a consulting arm to it, and built that up.
That's pretty amazing, because it almost sounds like, through your work with Grandin Toy, you happened upon a problem that wasn't being solved, right? Mm-hmm. And you kept going with that. It's very, in venture land, at least the last few years in my experience, venture investors are very worried to invest in service companies that try to become product companies, which it sounds like what you did.
Yeah.
But it happened very organically and very naturally from the needs of the customers you were servicing, right?
Yeah, exactly. And I'm sure it can happen again, but it is a difficult transition because as a consulting firm, you like when the project takes a long time. You like when there's a lot of
more billable hours.
Exactly. So you're focused on billable hours, not on efficiency. So if you make your product better, you're going to cannibalize your consulting business. And so there's an inherent tension in the firm for that. But we just naturally moved towards better and better products, and our software became the way to get consulting engagements. And then, but it was the old software licensing model. The concept of ARR was not common, of recurring revenue.
So it's like a license and maintenance model?
Yeah, typically it would be, we would license it for somewhere, because say 50 to 100K for a annual licensing fee. Actually, no, it was a perpetual license fee, actually 50 to 100K for an forever license, plus 18% annual maintenance fees was the typical model back then.
Right. And just for the people that don't quite understand the difference between SaaS, software as a service, and license and maintenance, SaaS is essentially renting software, whereas a license, you're actually selling the software, meaning the customer owns it and they don't have to pay anything outside the license. And then what's typically done is you charge a maintenance fee so that any updates or any issues that happen along the way gets dealt with by the vendor, by the software provider, right?
Right, exactly. And so the old model was really good for cash flow because you could bill the whole thing, the full life usage of it up front. So you bill a bigger amount up front, but then the next year you only get an 18% of that as a annual maintenance fee.
Right. It's kind of like leasing a car versus buying a car with finance.
Exactly.
You're always going to pay more on the lease aspect of it, but you pay more upfront if you're buying the car outright.
Correct.
That's kind of the difference.
The other part is that the economics in terms of valuation, a recurring software license model, you just get valued a lot more for that these days than the perpetual license. And so it doesn't help your top line valuation, but it does help cash flow. So it helped us meet payroll, grow the business, and run the business all the way through without ever borrowing money or raising outside financing, which is quite uncommon in today's world.
And that was probably well before cloud computing was a thing. So you probably have to do everything on prem and deal with that. You have to go on customer sites and
to put yourself back in that time frame. We had competitors starting to come up in the cloud model just before we sold the company, and our pitch was, how could you trust the cloud? It's so unstable. Your data's out in the cloud. Someone's going to steal your data, and it was all this fear and uncertainty we would push out there regarding how bad cloud is, how good on-premise is. And it's the complete opposite now.
Right.
Today would be, how would you think of building your own, hardware on site and doing that whole thing? It was just a whole different mindset change in the market.
So if you had to describe the problem you were solving kind of like in one sentence, how would you, especially as it transitioned into software, how would you define that?
Well, we sold solutions to the Office of Finance, and we helped make that process more efficient. And we had two main arms. One was in the budgeting planning space, so helping companies do their annual budget, long-range plans, and other analytics around the data. And that was a great business, still is a great business today. There's a big need for that. Every company does it a little bit differently. And so there's a need to tweak the software for every customer. And the other newer area was a technology we acquired midway through our run, which is on financial reporting. And a report can mean a lot of different things. It could mean like an Excel spreadsheet, you print it out and there's your report. Or it could be those big, beautiful, glossy documents you get from a bank. Like here's my annual report, which is a cover page and a letter from the shareholders and the financials, the notes, charts and graphs and pictures and all that kind of stuff. So we did the latter. We helped companies automate their statutory reporting, the SEC filings for 10Ks and 10Qs. And we were acquired because of our expertise in that area.
So you would save a lot of time and effort and energy, and I assume even made the reports more accurate because you're pulling in the data that you're already capturing.
Yeah, for sure, all the efficiency, all what you said, but the real driver was that back then there was the Enron scandal, there was a whole bunch of scandals, and SOX came out, so Sarbanes-Oxley compliance, whole bunch of rules. And a new thing was that the CFO of the company had to personally attest to the financials that they were accurate, and they would be liable if they were like personally liable if they were inaccurate. And so that kind of focus led board level discussions at mid-sized big companies that we need to put more controls around that. And so we had a process that moved from a typically Excel Word type of process on its own to a robust system with audit trail and compliance built into it. So a much more efficient and auditable system.
So you built this business to over 400 employees, over $50 million in revenue. And I kind of get how you were able to do that from I assume you took the consulting revenue and you plowed that back into building software and sales and all that. But that's like a heresy today in venture capital land or startup land to be able to build a business of that size and magnitude without having to raise external capital, even to build a consulting business. So can you walk us through why you never raised money? Did you just never need to? Was there an opportunity to even raise more and grow more and you decided not to, for example? So maybe walk us through that.
I think it was mostly naive and not really knowing the ecosystem. We were just very focused on running our business. We were just trying to close the next bit of business, keep growing bit by bit. And as we went along, we saw other companies got acquired. And we thought that was advantageous for us because when one of your competitors got acquired, you typically get pulled into that company's ecosystem and you sell back into that customer's base. And they're less focused and relevant in the kind of open market we were in. And so I remember a slide at one of our annual conferences where I showed this guy got picked off and this guy got picked off. And we're now the leading independent player in what became called the CPM space, corporate performance management. But what we didn't really realize was that all the other big companies that wanted an asset in the CPM space had already bought one. And now we were the lone guy out there, and all the big guys that could acquire us have already got one of their own and didn't really need to buy another one. So it limited our acquisition space in the core CPM market. It let us grow bigger, but we were it was more a lifestyle business, trying to grow the business and run it for, just to pay our employees, pay ourselves and move on kind of thing. Later on, we realized we really should consider an acquisition. And we had our new product line for the external reporting, gave us an opening into a new space that was a hot space that triggered that whole process. But we didn't really think about financing except how do we make payroll? And we were always able to make payroll and grow. And so the need to get outside capital to grow quicker, we never pursued and we weren't offered it very often or much at all.
Yeah, and back then the VC industry in Canada was tiny. It's still pretty small today, but back then it was like a fifth or a tenth of the size it is today. It's quite amazing how large it's grown. Yeah. But you ended up selling the business to IBM. I mean, you put yourself on one of the rare Canadian entrepreneurs to build a significant business, not only in general and then sell it, get a successful exit, but also do that without venture capital. How did you think through that exit? Like, why not just keep the business and keep it, growing it the way you were doing it? Well, how did you and your partner decide to sell the business?
Yeah, so my partner and I, we were talking through this, and this is maybe a year or two before acquisition, and saying we really should consider an acquisition. Like, we're a certain size, others have been acquired. This could be a way to secure the financial health of your family, et cetera. So um, we made a conscious effort to look into it. We start to get our house in order, and you realize how if you're not a venture-backed firm with outside controls and a proper VP finance, and you don't have to report to the board every quarter, your internal house cannot be as is not. And we were not that well organized internally. We had a bunch of stuff to clean up to make ourselves clean and appropriate for an acquisition. And that took about a year or so to just get organized. And then we hired a banker. It took us a while to find the right banker. And we started to pitch the story out there. So it was we were looking at it as, let's check out the option. It wasn't like we need to sell, but this is probably something to consider. And then as you get out there and you see the interest level and the prices that you can get, you say, well, this probably makes sense. But it was a very roller coaster process, to say the least.
Mm-hmm. By that time, you were running the business for what, 13, 14 years?
Yeah, it was a 15-year run by the end. So particularly when you start as a consulting firm and slowly grow the business, it's not what a VC is looking for. They're looking for a much faster growth rate. They want to double, triple in the early years in terms of the size of your business. Here we were growing 30% a year pretty consistently, and that compounds over a 15-year run, but it does take a while to get there.
That's pretty impressive at that size already. You're doing tens of millions in revenues by the time you're thinking of selling the business, and growing at that rate without external capital. I mean, the best, even venture-backed startups often fail quite short on doing that. So that's pretty amazing. Ultimately, you decided to sell at was 2010, right?
We sold in 2010, yeah.
Right. So you sell the business. You joined IBM for about a year, 2 years, right?
Well, yeah, they gave me a 3-year retention package,
Mm-hmm.
And I made it 8 months, which I thought was pretty good. My partner,
It's pretty common for, when you sell a business to like not work out so well in the corporate
yeah,
environment.
the big blue machine was not my world. It was the structure there was different. The rules were different. We were used to making our own decisions, just deciding and executing right away. And the world became quite different in a big company, as you would expect. My partner only made it about 3-4 months before he decided it was time to move on. So he exited even earlier than I did. And then it's interesting to know, like, now what do you do, kind of thing. So I didn't want to go home and like lie on the beach, watch TV. You drive yourself crazy. So I started into venture capital investing, not VC investing. It was more angel investing for early stage tech companies, more to stay engaged with the ecosystem and to see what's out there and to make a bit of money as well.
Right. That's pretty interesting. So most successful entrepreneurs I know, there's this perception, I think a false perception, that people want to build startups for kind of the financial freedom, which I think is true. It's partly true. But once anyone that has the ambition and capacity to actually get to that point never just wants to, use that financial freedom to sit at home and do nothing, right? Like you expressed. You always have to be on the move, doing something, investing, build, like even if it's just like charity, work in the community. So you leave IBM after 8 months, and then you do angel investing, and you do that until you started Incapital Ventures, right?
Yeah. I was angel investing for 6-7 years, kind of thing, until we started putting together the idea for Incapital. And we had a number of good successes, again, focused on B2B enterprise software. A few home runs, a few middle of the road plays, but overall, they all played it nicely. And then for a variety of reasons, we wanted to start Incapital, to take outside capital and to be able to go after more traditional Series A, Series B financing and follow the VC model. So it was a good opportunity, and I think the right move for us. It worked out nicely.
Mm-hmm. And why raise a fund at all? I mean, you mentioned to be more formalized, but you could just keep investing. I assume you could just keep investing and not do the formal fund.
Yeah, it was a bunch of stuff. My wife is a GP in the fund, so it was great for the two of us to do it together. And we have a partner in Israel, so we invest in Israeli tech companies. And there's a very dynamic scene in Israel, even more so than Toronto. Probably not quite as much as Silicon Valley, but there's tons of outside capital that's coming into the Israeli tech ecosystem. Very innovative, deep tech, good valuations, like it's a really strong market. So we wanted to play in that sandbox. And if you want to lead deals, you need to be able to write checks that are significant and to lead around.
Mhm.
I wasn't in a position or I wanted to put that much of my capital at risk in it. I'm still the largest LP in our venture capital fund. But now with the other capital, we were able to do traditional Series A, Series B financing, lead the majority of those rounds, um, and play in an ecosystem that's a bit more dynamic,
Mhm.
and also learn a ton. I've learned a ton on the VC side of the fence as opposed to just the operator side of the fence.
So, what are you looking for in a great investment?
Um, the core for me is the product that this company has um, a significant improvement on what else is out there. Do they have some proven product market fit and proven traction so that if we put money into them, they can use that to scale very quickly?
Mhm.
We're not looking to spray and pray across 50 or 100 different deals and write a whole bunch of small checks and just kind of occasionally hear what's going on because it's just too many to monitor in detail yourself. So we have a concentrated portfolio of like 11, it'll be 12 soon, um, portfolio companies in our portfolio that are all enterprise B2B software based companies that are overall performing quite well. And we're looking for core products that are significantly better than what's out there now with teams that can execute. Uh, and they're looking for capital to help grow them. We're not looking to fix problems, and we're trying to help accelerate growth and drive significant outcomes for the founders and ourselves.
You're looking for great stories and make them even better with the
Exactly,
capital. Yeah.
exactly, yeah.
And, you shared some deals with us and we've co-invested on one company at least
Hmm.
by the recording of this video. And I mean, it's great. You clearly, you were the lead investor and the kinds of companies you've engaged with and invested in are
Hmm.
high quality, great entrepreneurs, great traction. Like it's always a pleasure receiving leads from your firm. So it's pretty incredible. I assume some of that at least is from your experience as an operator, right? Like you know what to look out for, you know how to identify what's working versus what's not, relative to maybe a VC who doesn't have that experience.
Yeah, I get that kind of feedback from the founders that they like talking with ourselves because we come from an operating background. And so when they explain the problems, you don't, like another VC might say, well, just cut your headcount this percent or do a more financial focused. And we realize that it's difficult to get stuff done. It's difficult to hire a VP marketing that's going to uh, just drive leads and not want to do a much grander marketing department kind of thing. And I coach them on how to find, because these small companies can't afford to have the nicest booth at the trade show and and do everything that you could possibly do in marketing. You really need to focus on driving leads to your company. And so those kind of insights into helping them find the right people to coach them, it's fun to do. And our background as operators helps that. And they tend to appreciate that kind of focus as opposed to strictly a financial focus.
Mhm. And geographically wise, you mentioned you invest in Israel, which is interesting. I'm curious about that as well. But you also invest in Canadian startups, I understand.
Yeah. So our mandate of the fund is to focus on Israel, but not exclusively.
Mhm.
So of the 11 deals we've done, 9 are based in Israel, and 2 are based in the Toronto area. And just from my network here, I come across good deals here too. So uh, that's kind of where we typically fish in the Israeli tech ecosystem. And so we're back and forth all the time, and we have a team on the ground in Israel that's doing all the lead generation.
Mhm.
So we're a very kind of international fund where we're a Canadian fund. A lot of it, our investors are based out of Texas, actually, and we invest very much focused on Israel. So um,
That's
kind of
interesting.
unique in structure.
Texas investors and a Canadian fund investing in Israeli companies. That's
Nothing, we didn't really plan for it to work, just worked
yeah,
out that way. So
that's globalization if there
exactly,
ever was such a thing.
exactly. Yes.
That's pretty interesting. I mean, I'm curious. You mentioned a couple of reasons why Israel is a target for your fund. I
Mhm.
mean, I've experienced that as well. I've been pretty open and public about not only my support for Israel as a nation, because I'm Israeli and I'm a Jew and all that fun stuff, but also the quality of companies that come out of Israel are just very high.
Hmm.
And it's something in the water or the ecosystem or the culture or the fact that everyone has to go to the army or national service. But you have great companies coming out of New York and San Francisco and Boston, and even Toronto, right,
Yeah.
which you've invested in. Why not focus in on, something like New York where you're pretty close rather than Israel?
So a couple reasons. First of all, on the fundraising side of it, when you pitch potential investors, you need something to differentiate yourself to say why, because there's a ton of funds out there and a lot of good funds, a lot of bad funds too, but a lot of good ones. And the cachet of the Israeli tech ecosystem is quite high and well respected. And there are people who really want to be part of that and have a story to say in that area. So it helped, I think, in the fundraising as well. Uh, and it's a very dynamic market. I'd say the Toronto market has kind of lots of good companies, although the tech is a little deeper in Israel. And there's also an inherent structure in Israel that complements the tech ecosystem more than most other places. So in the Israeli army, which is a mandatory service, as you know, and as you probably know, there's the largest part of the army is the 8200 unit or 8200, 8100, which is the tech part of it. And there's a big group of people that come from the high school systems that get drawn into the 8100, and they get trained up on how to be software engineers or mechanical engineers, and not from a academic perspective necessarily, but to get the job done and to solve real problems. And that ecosystem feeds into the tech ecosystem for the startups and helps spawns a ton of startups in that area that really has been very successful. And so there's a big push for the whole society towards that. I think they have more startups in Israel than any other company on a per capita basis. So there's a lot of companies to choose from and also a lot of capital in that market.
Mhm.
So a lot of corporate VCs will have an office in Israel or have interest in Israel. So in addition to the traditional venture capital is the corporate VCs. So there's ways to bring capital and talent together to make good outcomes. So
Right.
that's why we fish there.
Yeah, the latest data I've seen is that per capita unicorns come out of Israel. They're number two, just behind Singapore, and the U.S. is number three. It's pretty incredible given
Mhm.
all the the challenges that Israel faces.
Exactly.
Um, and the way I understand it, the way it's been explained to me, is that the entire society, in high school, they're kind of cherry picking. The army's cherry picking for the
Yeah.
most, for intelligence, for leadership, for all that, all those kinds of traits you'd want in an intelligence unit or a technical unit,
Yeah.
like 8200. And then you're spent 3-4 years, not only training, as you said, but trying to solve real problems for the
Yeah. Yeah.
society, for the army. And not only that, after they leave, they have a whole support system to help them build companies. Not only the government supporting them financially in some cases,
Mhm.
but the whole civil society is like elevating these entrepreneurs.
Exactly. Exactly. Yeah. So it's been great. And we've seen some really strong companies. And some of them are taking off really nicely.
Yeah, so a
Um,
lot of lessons there for the Canadian government, maybe, or for Canadian society to emulate,
yeah.
replicate, and
Yeah.
try to figure out how
Yeah.
to spur entrepreneurship here.
Just to make a political type statement, but the idea of raising capital gains taxes and disincenting investment in the country is just gonna, like, if you're gonna fish in a given market and invest in a certain area, you'd say, well, why would I want to do it in a Canadian market where, a big chunk of the return has just been removed? So government policy can make a big difference. And in Israel, they're really trying to be supportive.
Right.
Yeah.
I mean, I talked to obviously a lot of entrepreneurs and a lot of VCs in my day to day work, and it's quite amazing that there's always been a problem in Canada, what's called the brain drain. Doctors and lawyers and professionals and people with money generally want to leave to the U.S.
Yeah.
And the only there's a lot of people that want to start businesses in Toronto and in Canada, but the more, like you said, the more difficult the government makes it for people to benefit from the fruits of their labor, you're you're just encouraging more people with capacity and ambition to go start their business in a place like the U.S.
Completely.
with a more better tax code and
Yeah.
better ways to make money. Not only the fact that it's a market that's 10 times the size, which in and of itself gives someone enough reason to just go start a business in the US
Right.
if they can.
Well, when we were running Clarity, and I say this to our startups too, that if you want a foothold in North America, Toronto was and still is a great place to be because you can get the same quality talent as you can in the States, but you're paying Canadian dollars, not US dollar. So the salary is just a little bit lower here. The medical system is covered by the government here as opposed to in the US, you got to pay more for that. So you can get good talent, slightly better prices, and access the same market. But government policy is making that more and more difficult over time.
Which is very unfortunate.
Yeah.
When you're looking at investing in a startup, what are some key red flags that you see where you say, hey, this thing that you did or said or whatever's in the business is a reason we have to say no?
Well, first of all, I found that every pitch, every company we've seen, there's always this assumption that right after I invest, there's this big hockey stick of growth about to occur. Maybe it's serendipity. I always happen to come across a company like that, but there's always this claim of dramatic growth right after the new money comes in.
Yeah, right after.
They've been growing flat nicely, but they're about to take off. And so you got to look at that with skepticism. And I find there's an inherent situation of line. Sometimes it's just omission. They don't want to really talk about kind of the dirty laundry, the tech stack's a little bit weak or the team is a bit weak in this area, or you just got to really dig to find out where the weakness is. They don't want to bring that forward, obviously. Occasionally, there'll just be misrepresentations you have to find out. So the first thing is the deck you're seeing, the questions they answer, are they accurate? Are they fair representation of what's going on? And that's a big first hurdle to get over because you need to really dig to find out if that makes sense or not. And then you need to say, is the product they're offering going to really give to their customers good value, more than what's out there today, such that a customer is going to buy your product? Because it's really hard for a small company to compete against their big competitors that are entrenched. They've got no or much less track record. The big guys can really dump on them in terms of fear of stability, longevity. They've probably got, a slicker sales team, slicker marketing materials, all that kind of stuff. So the core product has to be that much better to overcome that. So if it's not 5, 10 times better than what they've seen already in the market, then it's going to be a tough slog. There's got to be something unique and interesting. And then the team has to be able to execute.
Mm-hmm.
Can that leader have the right mix of leadership, focus, risk-taking, competency, and building a great product is typically the easier part of it. Taking it to market and finding a go-to-market that's efficient and can really scale is a hard thing to do, and to beat the competition because everyone's trying to get that same customer.
Right. You point out something quite interesting that I find many entrepreneurs, less experienced ones, don't quite understand, is that even if your product is better, it doesn't mean you'll get the customer, even if it's substantially better, because there's a significant bias towards the status quo, especially in the enterprise. Like nobody's getting paid to increase efficiency by 3% of this as a result of a new software system.
Yeah.
They're getting, and there's so much risk inherent to that, especially with a startup. So the product just has to be leaps and bounds better than the current status quo.
Yeah.
We're solving a problem so significant that it's not being solved today by something else. So that's a very great insight because I find that a lot of entrepreneurs aren't really getting that.
It also is where you want to focus on your selling your product. First of all, you want a product you can sell anywhere in the world, or at least across North America at the very least. So it can't be just a very niche kind of localized thing. But I found selling, like if you want to sell, you have a solution for big banks and you're a startup in Canada, it's almost impossible unless you're brand new in a market. You're the leader because it's a new niche no one else has done yet. But if you're competing with incumbents, the big banks are not going to go with a new startup. They want it proven elsewhere.
Mm-hmm.
Whereas if you take that same solution to a mid-sized company in the States, in Texas, those kind of markets, they're much more open to taking a risk and they'll trust their judgment more than needing a third party validation of it. And so you want to focus on the size of company and also where they're located, so you're going to get the most likelihood of getting that initial traction. Once you get to 5, 10 million of revenue, to then go from that to 20 is way easier than the first 5 or 10. The first million's tough, very tough. It gets easier over time. And since we invest in companies that are typically in the earlier stage, you need to make sure they've got the product that's that much better and know how to take it to market so they can really get those initial sales and get going.
Mm-hmm. So there's a lot of news out there about startups struggling to raise capital. Venture financings have declined by over 50% since the peak in 2021, 2022. What advice would you give startups that are watching this, that are looking for, that are unsuccessful or struggling to raise venture capital? What would be your advice to them?
It is very hard, especially if you're new to it and you don't have a network of. On the flip side, if you are an experienced entrepreneur, you had 3 or 4 VCs on your board, you had an exit, they all made money, you can call them up, explain what you're doing now, and they'll take a very warm, interested look at you. They're not going to necessarily invest, but they're going to they'll take the time to take a serious look at what you're doing. And if it's credible, they're more likely to invest than not because you've proven to them you can do it. If you're a first-time entrepreneur with no real track record, no connections into the funding ecosystem, whether that's angels or VCs, et cetera, it really is tough. And you need a great product. You need to get out there and hustle, and pitch and pitch and pitch, and make it as attractive as possible. You can do things to make it, as opposed to leaving it wide open, to, tell me what you think it's worth and let's talk about it. You could put out there evaluations a little bit lower than you think the market is to get more traction. You could offer liquidation preference terms to incent people to come in, and you'll say, look, if I'll give you a 2x liquidation preference, because you're so confident you're going to grow way well beyond that and then before the next round of financing. So it's not going to really cost you anything if things go well, but it might incent people to come in. But it's a lot of hustle. It's a lot of knocking on doors. It's a lot of pitching. But at the core of it, you need to have a value proposition that is significantly better than what's out there today to get people's interest to even talk to you. And then you have to show competency that you can execute on your plan.
Mm-hmm. That's great. Any last words of advice for aspiring VCs, entrepreneurs?
I'd say it's a great ecosystem to be part of, both as an entrepreneur get started and investing. I've enjoyed both sides of it. They all take a lot of work. And hard work, diligence, and focus. There are a lot of good examples out there of smart people who've done it before. So take lessons from others, but get in there, work hard, and make sure you're offering value, whether you're giving money and good advice and value from that, in addition to that, or starting a company with a business offering that adds dramatic value to your customers. If you offer value, it's going to work out.
That's a great piece of advice to leave off on. And thank you, Mark, so much for joining us.
My pleasure. Great chatting with you today.